Okay, Jessica Duncan from La Jolla, California asks, how does a loan modification work? And what are the possible adjustments? It's kind of a big question, so I'll give a general overview of how it works and what the adjustments are. Essentially, a loan modification is simply just the adjustment of the terms to your original loan agreement. So what terms can be adjusted? Now, when you first get a loan, you agree to how long will your loan be, 30 years most of the time. Or if it's an adjustable, maybe it's a 5 years fixed rate and then it moves to an adjustment period, those kind of things. So what terms can be adjusted? Just about anything. First thing that can be adjusted, and the most common thing, is a rate reduction. They can take your rate from 6% to whatever percent they deem necessary to help save you money. And essentially, they just lower your interest rate. And that lowers your payments, and everybody's happy, supposedly. They can lower your principal balance. This is not quite as common, although sometimes it does happen. And actually, there are certain programs that are coming out now that do offer a principal balance reduction. It's actually a principal reduction program. It's not a loan modification program. It does I guess in effect it does the same exact thing. But with a loan modification, you can actually lower your total loan value. So if you own a home and you financed $200,000 and now it's only worth $100,000, the bank could possibly lower it to $100,000 so that you can be at market value, and that would lower your payments in effect. The length of the loan can also be adjusted. So if you have let's say you have a 30-year interest only, and you need your payments lowered. What's going to happen is they're going to switch you over to a principal and interest loan, and that will cause your payments to go up. So to offset that, a lot of times what they will do is they'll take your interest rate and they'll drop it down a couple points, and that'll lower your payments, and then they'll stretch your loan term out to, let's say if you were at 30 years, you would be at 40 years, and that would offer you a reduction in payment per month. Another thing that they do is if you have paid, let's say you got your loan 3 years ago or 4 years ago, and your 501 ARM is about to expire, your term left is 26 or 25 years, I guess, on your loan. They can move that term back up to 30 years to help you realize a greater savings in your payments. So it's almost like a refinance in that you're refinancing for 30 years, but you don't get to pull any equity out. The other thing that they will almost always adjust, except for when you're in a 30-year fixed principal and interest loan, is the type of loan. They'll take you from an interest only to a principal and interest. They'll take you from an option arm or a 5-1, a 3-1, those kind of loans, and they adjust you to a principal and interest loan. Their objective is to put you in the safest loan possible, because the reason we're all in this mess in the first place is because loan officers were selling loans that were volatile and people couldn't keep up with, and not explaining them well enough to the borrowers, to the point where people were taking out loans that they really couldn't afford, but loan officers were twisting the data around to make it look like they could. So those are the things that they would most generally adjust in your loan modification. Okay, so how does it work? This is almost an unanswerable question, and the reason why is because every bank has its own procedures and processes, and they have all different documentation that they require. There's no federally mandated guidelines. When you apply for a loan, there's underwriting guidelines, and these guidelines have a set documentation standard that is required for all things. They pull a credit check, they get your W-2s, etc. With a loan modification, each bank does it however they want to do it. So the question is really hard to answer, but as a general overview, this is pretty much what the process looks like. Now, you can go to easyhomeloanmod.com/20 free videos, 20-free videos, and I have a PDF of this that you can download and take a look at a little bit closer if you'd like. But the general process goes, you apply, They review your application, and then they either approve or deny you. If you get denied, they most of the time tell you why you got denied. Either you don't have enough income to meet a modified payment, or you don't have any other stipulation that they might have. So you have to figure out why you got denied, make those adjustments, and apply again. It's a vicious little circle they put you in. If you do happen to get approved, a lot of times what they will do is they'll ask for further documentation, and this could be in the form of a workout package, which includes like bank statements, W-2s, hardship letters, any of their required documentation. And you may have to continually provide these during the process of your loan modification. So if a loan modification takes 3 months, you might have to provide your bank statements or your W-2s 2 or 3 times. At that point, you do a lot of follow-up, continued follow-up. The bank is not motivated to help you out, so you have to call them on a weekly basis and be like, what's the deal with my loan modification? Is it done? Is it moving forward? Do I owe you any paperwork? That kind of things. Once you get to the point where they've assigned your loan to a negotiator, they will come up with a set of terms and they'll send you out documentation outlining these terms. You have to negotiate these terms unless you're happy with the first offer that they make you, which is sometimes good and sometimes bad. You essentially have to look over the terms and decide, will the new terms achieve your goals and make your home affordable? If they are, then you sign the documents and you start paying your new mortgage. If they're not, then you get to renegotiate, and it's back and forth with the bank. Once you sign your docs, you have to pay your new mortgage amount, and many times the bank will put you on a probation period. So maybe in 90 days or 180 days where you have to make your mortgage payment on time. If you make your mortgage payment late, then they can revoke your loan modification, take your home, put your home in a foreclosure, that kind of thing. So you really, really have to read through all of the terms and make sure you understand fully what you're getting into. And it's a case-by-case scenario. Every bank is different. So make sure that if you don't have somebody to help you guide through, if you're trying to do this by yourself, make sure you read every line, dot your I's, cross your T's, that kind of thing. If you don't have the time or energy or knowledge to do this by yourself, I would highly suggest reaching out to the services of a professional company and hopefully getting somebody to handle your case. So that's pretty much how a loan modification works, and those are the terms that you can adjust. If you'd like 20 free videos teaching you pretty much everything you need to know about loan modifications, go to easyhomeloanmod.com/20-free-videos. Thanks.